The Bank of Canada is expected to announce this week that it is leaving interest rates unchanged and continue to leave the impression that it's in no rush to move them off ultra-low levels. No surprises are expected Tuesday, with economists confident the central bank will continue to keep its key rate unchanged at 1%. And the bank will likely leave the language in the announcement largely unchanged, indicating that a hike in rates is still far away amid worsening economic conditions around the globe. The latest indication of weakness came on Friday when Stats Canada reported there was no growth in gross domestic product during September, following a 0.1% dip during August. There will likely be another reading of weak growth on Friday when the agency releases the November employment report. Economists look for around 5,000 jobs to have been created during November. U.S. jobs data also comes out on Friday, and expectations are fairly muted, largely because of the impact of Superstorm Sandy in the Northeast. Meanwhile, it's the fear of worsening economies that is expected to produce another volatile week on stock markets. Traders will look for some progress in avoiding a serious budget impasse in the U.S. that could result in steep tax increases and significant spending cuts at the start of 2013. This is the fiscal cliff scenario, and the worry is that those cuts and hikes would shock the U.S. economy back into recession. The Toronto market and the Dow Jones Industrials ended last week essentially flat, with markets whipsawed between positive and negative territory during the sessions, often depending on the latest take on fiscal cliff talks offered by a prominent Republican or Democrat. From the Canadian Press, I'm Malcolm Morrison.